Okay, so this is a commercial loan scenario. Again, walking through a general live scenario of how do we size up a transaction with particular questions, with the intention in mind at the end of it to really ask, once we get all this information from them, how do we deliver feedback to them? What do we tell them once we do this? So this is for the benefit of the loan associate. So in this particular scenario, we're talking about an investment property. It's a refinance of a single tenant. So there's one tenant, and it's a local tenant. So it's not a national tenant. It's just one tenant locally. This was an industrial building. Owner was looking to refinance. Single tenant building, no cash out, just to get better rates. So that was the scenario that you can kind of high level get a statement. So again, asset information, that's the first thing we're trying to figure out on a real estate deal. Tell me about the building, if there's been any historical environmental issues. And we want to know if there's been a phase one done on the building is always critical to ask. What is the square footage of the building? And what's the land's square footage? So these are good things to ask so you can start to get a sense for the price per foot. If the loan per foot is important because you're like, oh my gosh, it's $350 a foot. That's pretty high, and we might need to do some homework on that. If it was in a dental office, that's probably pretty normal. If it's an industrial building, that could be an issue. So that's helpful to understand. What's the condition of the building? In this particular case, it was a 20,000 square foot building. It was pretty newly built, 2016. So we're not worried about environmental issues and some other things that have happened because they had to have gotten a phase one if they built a new building. And so we were comfortable with collateral, no issues there. So once we've done that, again, we're going to move on to urgency. What is the, again, we're always trying to figure out, is this a why? Is this like a absolute, I have to do this, it's really important, or is this it'd be nice, to do it or not. So we're always weighing that to ask ourselves, is this somebody who's really committed to doing the transaction or not? So again, we're saying, what's driving you to do this at the time? Why not wait? What happens if you don't do this? Just so we can see if, how urgent they are and committed. In this particular situation, he needed to take this out because there was actually an issue with the tenant. So when he had booked an SBA loan, what he didn't realize, because he occupied it originally, was that there was a UCC filing on all of the equipment that the lender put on there, which is just another fancy name for Uniform Commercial Code to try to lien equipment. And so what happened was when he sold the business and leased it back to him, he sold the equipment. Well, there was still a lien on it. And so when he found that out, he went back and flipped out and said, this is ridiculous. We need to retrade the deal. And so this part was really motivated to get that loan taken out, get that UCC filing off the equipment so that he could not be in the bad seat of the negotiation and have to, bend over backwards, so to speak, to just kind of, get out of this issue. And so, so basically that was the urgency behind it. So we kind of go check, we're good there. Loyalty, again, what other lenders are you talking to? What's been their feedback? Who else do you have a dialogue with? We want to make assumptive questions. We don't want to say, well, who else are you talking to? We want to say, well, we don't want to say, are you talking to other lenders? You say, who else are you? Give them the ability to be honest with you. They were talking to their existing lender, but they really couldn't offer anything of value. So we weren't concerned about it. We'd worked with this client before. That's always a positive. And so we have a track record with them. So we were good. That was a check and a plus for us. Viability factor, again, cash flow, collateral, credibility. So again, what was your net income on the company tax returns last year? Not gross, but net. It hit the bottom line for the property, because remember it's investment. And then what is the personal income on the tax returns? Again, he made money last year. He was able to show us there was good cash flow. There's lease in place, so that was a big plus. Obviously, he had not filed tax returns, but some of the years prior were okay. They weren't great, but they were okay. What other debts do you have in your business and personal, or how much cash do you have on hand? He had good cash, so about, call it, 200,000-300,000 on cash on hand. We knew that he had some good outside income, so we were comfortable with that. And then obviously we go to the credit. Again, we're always saying, bankruptcy, foreclosure, short sale, lawsuits, any of those things in the last 5 to 7 years. Well, in this particular case, he had great credit, no issues, no bankruptcy, no foreclosure. So we're like, great. And then we also want to know loan to value. What was the loan to value? Well, it's a 50% loan to value. And he's been doing this for a long time, 5-10 years, has good experience. But it was a 50% loan to value. Well, that's great. That's a really low loan to value. So that gives us a lot of opportunities and options to do things. Obviously, it's a single tenant. So the other thing is, who are the tenants? So for investment properties, we definitely want to know for cash flow purposes, who are the tenants, or if there's one, how long are the leases? Now we've got 1 year left. Okay, it could be a challenge because you could lose that tenant potentially. And how are the tenants' businesses doing? So we're trying to understand those factors. Another thing you want to know is if it's a triple net versus a modified gross versus a gross. Remember, triple net is that landlord or the tenant pays everything, all the expenses. On the gross lease, the landlord pays all the expenses, and modified is somewhere in the middle between both of them. So we want to know those things as well, just so we can understand cash flow. So this is a true triple net lease, which is great. So the tenant, was a cheer company. We were a little bit concerned about it, whether they were going to be doing okay in COVID, but they were doing fine and still paying rent, even though they weren't up and operable, and had no issues about getting short pay or getting credits and discounts. So we felt very comfortable with what we had to work with at this point. For cash flow was good, a good debt service coverage ratio. We had probably 1.5 times, which is great. Credit was great. Collateral was 50% loan to value. Credibility, great history. He built the building, so we felt comfortable with this. This is positive. Expectations. What specifically are you trying to accomplish with the loan? What interest rate are you trying to do? What high loan to value, low loan to value? We already knew it was low loan to value. Prepayment penalty, you wanted none, just in case he wanted to sell. Turnaround time needed. He wanted to get it done fast, just because he wanted to get that guy off his back. But we're looking for a good rate and have no prepayment penalty, and speed mattered in us. So now we have some things to go off of. Okay, we know it's investment. Okay, so we're like, okay, we know we're either going to go life company, which is long-term fixed. But the problem with life company is they have a prepayment penalty, so that's not going to work. We could have gone with CMBS or commercial mortgage-backed securities. Again, prepayment penalty, very stiff, very expensive, and it takes a long time. Well, then we're kind of down to bank. So it was like, okay, or credit union. Well, we had a bank who had no prepayment penalty, had a 7-year fixed rate, high, low fours, 25-year AM. And so we basically just, understood that the natural concern of the tenant was tied to COVID. We were able to get over that. We told them we could get it done with conventional bank, 25-year AM, 7-year fixed. So whenever you're looking at investment properties, what you're wanting to focus on again is, what is the loan to value? Kind of remember that we're dealing with, 65 to 75%, usually 70-ish. We want to focus on the fact that what kind of prepayment penalty they want, because that will whittle down where you're going to send this to. Because if they don't want any, then you're not going to anybody but a credit union or a bank. Period. How long a fix do they want? And are they really, really focused on rates? Because if they're really saying, hey, I don't care, I'm going to hold on to the property a long time, I'm sticking around with this, well, then we're going to probably go with life company or, longer term fixed rate lenders, because that's where it fits. And so these give us, good telltale for this scenario. We're able to give them, we were able to execute, we were able to close. He was very happy, and gave us a great review. So, so again, this is sort of a scenario for an investment property, refinance, no cash out. Cash out matters, as you'll see later as well. That can cause some headache for lenders with borrowers pulling cash out, because they like to see them keeping all their equity in the building, and in this case, the low loan to value made a big difference when we're dealing with the scenario. So that's a investment scenario, refinance, single tenant, kind of industrial type of building that we're dealing with.